Hello all. Welcome to the Capital Markets module on market participants. In this series, we will learn in detail about the registrar and their role in the market, transfer agent and their role in the market, difference between registrar and transfer agent responsibilities, transfer agent role in mutual funds, credit rating agency and their role in the market, credit rating agency and its benefits to investors. Registrar. Who is a registrar? A registrar is an institution, often a bank or trust company, responsible for keeping records of bondholders and shareholders after an issuer offers securities to the public. When an issuer needs to make an interest payment on a bond or a dividend payment to shareholders, the firm refers to the list of registered owners, maintained by the registrar. One role of the registrar is to make sure the amount of shares outstanding does not exceed the number of shares authorized in a firm's corporate charter. A corporation cannot issue more shares of stock than the maximum number of shares that the corporate charter discloses. Outstanding shares are those that shareholders currently hold. A business may continue to issue shares periodically over time, increasing the number of outstanding shares. The registrar accounts for all issued and outstanding shares, as well as the number of shares owned by each individual shareholder. The registrar determines which shareholders are paid a cash or stock dividend. A cash dividend is a payment of company earnings to each shareholder, and a stock dividend means additional shares are issued to each shareholder. To pay a dividend, the corporation sets a record date. The registrar verifies the shareholders who owned the stock on the record date, and the number of shares owned as of that date. Both cash and stock dividends are paid based on the registrar's list of shareholders. The registrar changes the shareholder data based on current buy and sell transactions. Registrars exist for bonds too. For example, when an issuer offers a bond to investors, the company works with an underwriter to create a bond indenture. The indenture lists all of the pertinent information about the bond, including its face amount, the interest rate, and the maturity date. A bond indenture also certifies the bond is a legal obligation of the issuer. A bond may be secured by specific company assets, or simply by the issuer's ability to pay. Just as with stock, the bond registrar tracks the investors who own the bond and investors who should receive interest payments. When the bond matures, the registrar's records determine which investors should be repaid the principal amount on the bond issue. Mutual funds operate using a transfer agent, which is a company that acts as the registrar and also performs the duties of a transfer agent. While the registrar keeps records, the transfer agent handles the mutual fund unit purchases and redemptions. Now, let's move on to transfer agent. Who is called as a transfer agent? A transfer agent is a trust company, bank, or similar institution assigned by a corporation. For the purposes of maintaining an investor's financial records and tracking each investor's account balance. The transfer agent records transactions, cancels and issues certificates, processes investor mailings, and handles a host of other investor problems, including reissuing lost or stolen certificates. Transfer agents work closely with registrars to ensure investors receive their due interest and dividend payments in a timely manner. Transfer agents likewise oversee the mailing of monthly investment statements to mutual fund shareholders. A transfer agent plays a vital role in acting as a liaison between a company's registrar and an investor. There are many transfer agents in the market, with some of the top names being BNY Mellon, American Stock Transfer and Trust, and Continental Stock Transfer and Trust. BNY Mellon is reported to have almost 40.2% hold in the market. Now, let's see the difference between registrars and transfer agents. A registrar and a transfer agent are authorized to assist the firms and investors in recording shares and shareholder-related data. Their roles overlap, and companies often appoint any one of the two to perform all the roles. The few differences between the two are listed below. Transfer agents maintain shareholders' records and cancel and issue new share certificates. In contrast, a registrar registers the details when shares are issued in an authorized register on behalf of the company. Registrars can be record keepers, but the transfer agents work as shareholders' record keepers and corporate services providers. The work of the transfer agent is to see how many outstanding shares are present. In addition, they look at how many shares are being traded daily and their respective owners. On the other hand, the registrar's work is to identify who has invested in the bond and who should receive the payments. At the time of maturity, the registrar's documents determine how small an amount is to be paid. Then, what do mutual fund transfer agents do? They need to be a registered transfer agent. They perform the following roles. They provide support service facilities to the organization and the unit holders. Record and maintain the details of unit holders' accounts. Compute calculations on the income from mutual funds and transfer the same to unit holder accounts. Provide dividend-related tax information to the tax department. Provide annual and quarterly reports. Next, we move to credit rating agencies. Who are called credit rating agency? And what do they do? A credit rating agency is a body corporate which is engaged in or proposes to be engaged in the business of rating of securities. They are body corporates that give informed opinions on the performance of securities issued by firms and governments, after considering the risk factors to determine the likelihood that the issuers will repay the debt or can recover the losses in the event of default. Credit ratings provide retail and institutional investors with information that assists them in determining whether issuers of bonds and other debt instruments and fixed income securities will be able to meet their obligations. When they issue letter grades, credit rating agencies provide objective analyses and independent assessments of companies and countries that issue such securities. Key takeaways. Credit rating agencies provide investors with information about whether bond and debt instrument issuers can meet their obligations. Agencies also provide information about countries' sovereign debt. Credit rating agencies are regulated at several different levels. The Credit Rating Agency Reform Act of 2006 regulates their internal processes, record keeping, and business practices. These agencies came under heavy scrutiny and regulatory pressure because of the role they played in the financial crisis and Great Recession. Credit ratings Debt ratings or bond ratings are issued to individual companies and to specific classes of individual securities such as preferred stock, corporate bonds, and various classes of government bonds. Ratings can be assigned separately to both short-term and long-term obligations. Long-term ratings analyze and assess a company's ability to meet its responsibilities with respect to all of its securities issued. Short-term ratings focus on the specific security's ability to perform, given the company's current financial condition and general industry performance conditions. The Big Three agencies. The global credit rating industry is highly concentrated, with three agencies, namely Moody's, Standard & Poor's, and Fitch. Okay. These big three agencies seem to be independent, and whom do they benefit? Benefits to investors. Investors may utilize information from a single agency, or from multiple rating agencies. Investors expect credit rating agencies to provide objective information, based on sound analytical methods and accurate statistical measurements. Investors also expect issuers of securities to comply with rules and regulations set forth by governing bodies, in the same respect that credit rating agencies comply with reporting procedures developed by securities industry governing agencies. The analyses and assessments provided by various credit rating agencies provide investors with information and insight that facilitates their ability to examine and understand the risks and opportunities associated with various investment environments. With this insight, investors can make informed decisions as to the countries, industries, and classes of securities in which they choose to invest. Debrief. Here, we come to the end of this module. Now you should be able to explain registrar and their roles, transfer agent and their roles, difference between registrar and transfer agent responsibilities, transfer agent role in mutual funds, credit rating agency and their role in the market, credit rating agency and its benefits to investors.